few strategies that we're actively working with some of our clients now as we're preparing them, not just for sale, but for acquisition and where they may need to attract some finance. So we're working on that shareholder value aspect. So firstly, we see a lot of clients that say, look, we need to focus on growth. That's fine, but growth needs to be sustainable growth. It needs to be at a profit level, not just at a revenue level. And further, if you're going to focus on growth, it needs to be done with adequate capital. So it needs to be enough to ensure that the growth is a sustainable growth, so that you're either keeping your capital employed in the business at a constant level or growing it slightly. But you don't want to have to invest too much in capital employed, which will then diminish shareholder returns and shareholder value. So it's finding that sweet spot, as you can see in this little table, between B and C. That's where value gets maximized. And there's some real simple KPIs you can build into your forecast planning that focuses on return on capital employed. That's the key measure when you're looking at shareholder value. And similarly, when you are looking at strategies, it's having that value end game in mind. If you're looking at new products, new services, cross-selling, what is the impact on EBITDA versus capital employed? If you're innovating a process, looking at the longer term impact of profit versus the investment, and actually financially modeling that out. If acquiring a business, does the returns really justify the price? So particularly given sort of the state of where the economy is, where markets are, it's more important than ever to make sure that when you are investing, when you are looking at growth, that you are getting those right returns. And then there's risk. We talked about earnings multiples, and we get it a lot where people come in and they're told that their business is worth between 4 to 5 times or 4 to 6 times. And the question is, well, why 4, why 6? I mean, a large portion of where the multiple gets determined is in risk. So the higher the risk, the lower the multiple. So what we like to do in working out how to maximize a shareholder's value, or at least protect it, is to understand the risks of that business, and then build into their planning how to mitigate and manage those risks. I've had several clients that we've been working with, some of them for a while, that have a heavy concentration on 1 or 2 customers. Some of those customers aren't on contract. Some of them were on contract, have fallen off. So part of our business planning is to, for those clients, is to try and diversify into, more clients, looking to have more, a lower concentration in those 2 major clients, and then also looking to re-engage on contracting with them, so that, again, when that risk gets looked at, it's well and truly covered and doesn't end up pushing a multiple down. You need to be asking the question, what really is the intellectual property in your business? A lot of people think it's the goodwill. There's more to it in terms of what intangible value is. It's customer relationships, it's contracts, it's the people, it's the processes that you run. It might be a piece of software. It might be, a strategic supplier contract that you've got. All those things form the part of what your intellectual property is, and it's often these items that drive the value. So you need to be looking at how to protect that IP, whether it can be done legally by, copyright, by having contracts or other means, having heavy confidentiality agreements with staff or non-competes. Further, a lot of times that intellectual property is in the key person, and that's the owner or founder. So we really do need to work out how to transition that key person intellectual property from that person to the business, so it becomes business IP. And once it's business IP, it's saleable. It's saleable with the business as opposed to saleable with the person, and typically demands a higher value. And finally, we can't overemphasize the importance of having tax affairs in order. A lot of times we see people embarking in transactions, and a little bit of planning could have stopped a fair amount of shareholder value eroded by the impact of tax. So understanding earlier, is your corporate structure the most efficient for dealing with future tax matters like capital gains tax? Can you make sure that you get access to the CGT discounts, to small business concessions? So that planning now for something that might be 2, 3, 4, 5 years away will ensure that you get all the concessions that you're entitled to. The other area that we like our clients to look at is areas in employees, particularly in healthcare businesses, understanding that they've got their employment taxes correct. And that's often looking at whether people are contractors versus employees, looking that they've covered their fringe benefits tax. Adherence to awards is really a major part of due diligence that we see buyers looking at and making sure that, particularly if you're a nursing agency or you're a business that has a lot of employees and a lot of them are on different awards, making sure that you're compliant with those awards. And then ensuring then that the entitlements that those employees should be having accrued are correctly calculated and provided for. The work that you do now, will pay for itself many times over when it does get subject to an external review. We like to tell clients to operate like a public company. If possible, get an independent on the board. Get a limited scope review of your financials. Vendor DD is often a good way to make sure that when someone is going to look at your books and accounts, you're ready for your investment ready.